The data flowing through global markets right now diverges sharply from the headlines. While media coverage focuses on energy spikes triggered by Middle East conflicts, the bond and commodity markets are treating these price shocks as short-lived events. The primary structural threat to capital remains the accelerating United States public deficit. When a major natural gas reserve is bombed, it forces neighboring nations to choose between entering a regional conflict or leaving their economies vulnerable. This disruption forces global supply chains to sever established ties and seek new sources for both energy and agricultural components. We are already seeing the fallout. Shortages of natural gas restrict the production of fertilizers, which directly throttles agricultural output. In India and across parts of Asia, farmers are receiving less fertilizer than they need, driving up transport and production costs and pushing these nations to seek agricultural imports from external markets. This chart shows the widening fracture in the global energy market. On one side, the price of Brent crude, the international benchmark, is rising as it absorbs a heavy geopolitical premium. On the other side, West Texas Intermediate, or WTI crude, remains insulated and significantly cheaper. United States refineries are currently benefiting from this gap. They purchase cheaper domestic WTI oil, while their international competitors are forced to pay the expensive Brent premium, allowing domestic profit margins to expand. By raising energy costs for international competitors and restricting global fertilizer supplies, these regional disruptions create a market environment where nations like India face a choice: absorb rising domestic costs or shift their reliance toward American energy and agricultural exports. Federal Reserve Chairman Jerome Powell recently addressed the current economic climate, repeatedly stating, "We don't know," when asked about the path forward. When the world's most powerful monetary institution acknowledges that it cannot predict the outcome of regional tensions, the typical expectation is market panic. Institutional money is behaving differently. Professional fund managers have already insulated their portfolios by purchasing put options, financial contracts that allow investors to sell assets at a specific price to protect against a crash. They have already accounted for the current risks in their models. This chart tracks the VIX, an index measuring expected stock market volatility. Despite alarming headlines, the VIX has failed to break past the critical resistance level of 30. Simultaneously, the S&P 500 moves laterally, remaining within a predictable channel between 6,500 and 7,000 points. The data shows that institutional investors have already absorbed and discounted the geopolitical risk, establishing a firm floor under the broader market. To verify if the inflation threat is real, we have to look at sovereign debt. If rising energy prices were going to trigger a sustained inflationary spiral, the yields on government bonds would be surging to compensate for that risk. This graph shows the 10-year U.S. Treasury yield climbing to 4.3%, then halting. The bond market rejects runaway inflation. Simultaneously, the oil futures curve slopes downward, showing backwardation, where future commodity prices are lower than today's. Capped bond yields and the downward slope of oil futures indicate that the largest markets are treating the current energy shock as a temporary event. This explains why gold prices recently softened. Gold typically acts as a hedge against inflation, and its drop during a period of escalating tension shows that the market is looking past immediate inflation fears. The real pressure is the U.S. national debt, reaching $39 trillion and driving continuous currency debasement. This structural deficit growth devalues the dollar, providing the primary momentum for gold's long-term upward trajectory, making temporary price pullbacks buying opportunities.